In this week's video, we'll review numerous present-day charts to help us understand why everything we know about asset allocation could be about to change. We'll kick off the video with a stock bond chart that admittedly looks noisy and confusing. We'll walk through the concepts step by step, and they're very, very easy to understand. Most of them can be understood by simply looking at visuals and patterns. This quarterly chart shows the performance of the S&P 500 relative to a 30-year U.S. Treasury bond. Left side of your screen is calendar year 1985. On this slide, the right side of our screen is November 1st, 2016. The indicator on the bottom is ADX. It helps us understand the strength and/or vulnerability of a trend and the direction of a trend. All we need to know right now about ADX is, as of November 1st, 2016, black ADX was sitting at 12.09. If we fast forward from November 1st, 2016 to December 29th, 2017, two things are noteworthy. Number one, the ratio has broken above this long-term consolidation box that dates back to the mid-1990s. And number two, black ADX was falling. It started to rise, and it's moved from 12.09 to 16.34 as of December 29th, 2017, which was the last trading day of 2017. ADX is going to help us put some firm numbers around the concept that the longer we go sideways, the bigger the move that we can expect to get, and also around the concept that many may be uncomfortable with, the concept that good things could happen in this ratio for a long period of time, that we may now just be getting started. Again, this seems noisy and confusing. We've walked through this before in the past. It's relatively simple. This is from the popular trading book, Trading for a Living. It's referring to the single best signal for ADX. The single best signal for ADX comes after ADX black falls below both red and green. ADX black below both red and green. The longer it stays there, the longer the base for the next move. Look how long ADX black has been below red and green. It dropped below it in calendar year 2010 and stayed below both green and red all the way into calendar year 2017. This is our sleepy, trendless market, which aligns with price or the ratio. We have a sleepy, trendless market here with what now appears to be a bullish breakout. When ADX rallies from below both green and red, it shows that the market is waking up from a lull. ADX black is rallying from below both green and red and waking up from a lull. This looks like we're waking up from a lull. When ADX black rises by 4 steps from its lowest point below both green and red, which are known as the directional lines, here's the key concept. It rings a bell on a new trend. It shows that a new bull market is being born. Notice here, in November of 2016, ADX black has not even turned up yet, and it's been below both green and red since 2010, our sleepy, trendless market. And the fact that ADX black rose by 4 steps or more, and it has in this case, we went from 12.09 to 16.34 on December 29th, 2017. All of that rings a bell on a new trend, which aligns nicely with the longer a market goes sideways, the bigger the move we can expect to get. This book was written a long time ago, long before this breakout here, and it basically aligns with everything that we've been covering in past videos. That being the concept that good things could happen for a long period of time. If we fast forward to the end of July 2018, our breakout is holding, and thus far in the present quarter, stocks are outperforming bonds by 5%, just as we would expect after a breakout from a long-term period of confusion and consolidation. This here looks radically different from anything that we can see in this box. This is the first time that the ratio of stocks relative to bonds has been outside of this orange box since entering the box in the mid-1990s. We know from past videos, if you're having trouble believing that this is consolidation, the definition of consolidation is basically a long period of time with no progress. We can draw a horizontal line going backwards from 2016 and hit the ratio, no progress, no progress, no progress, no progress, no progress, zero progress from 1999 all the way into calendar year 2016. This is unequivocally consolidation. And market fractals tell us that consolidation on a quarterly chart that dates all the way back to the 1980s should be treated in the exact same manner as consolidation on a 60-minute chart. The only difference is the longer you go sideways, the bigger the move you can expect to get. So consolidation on a quarterly chart is much more meaningful than consolidation on a 60-minute chart. Let's talk about how this breakout may impact asset allocation expectations going forward, as well as investor psychology. What this is telling you is there was no clear winner between stocks and bonds over a very long period of time. And if you'd like to see that using a performance graph, if we went into a balanced portfolio, 50% stocks in red, 50% bonds in blue, in 1999 and held that portfolio, we would have been very, very pleased. Stocks and bonds did well over this period, and our balanced portfolio was extremely helpful. When the stock market tanked, the red line tanking, this is performance, bonds rallied. When the stock market tanked, bonds reduced volatility in our 50-50 portfolio and helped us out. That was true on a very long-term time frame. No winner between 1999 and February 29th, 2016. And it was also true on shorter-term time frames. Calendar year 2011. If you know your market history, you know there's a big stock market correction in 2011. If you migrated to defensive-oriented bonds or held a 50-50 portfolio, it worked very, very well over this period. When the stock market tanked, bonds went up like a rocket. So looking backwards from this point here, it's logical if people are saying, I'm very, very happy with my balanced portfolio. And at this point, they should be happy. A 50-50 mix was an excellent buy and hold combination from 1999 to 2016. And a 50-50 mix enabled you to offset the 12% loss in the S&P 500 from December 31st, 2010 to October 3rd, 2011 with a very satisfying gain in 30-year bonds. In the ETF world, this is basically, for the most part, TLT in blue and SPY in red. This is very, very similar to looking at SPY relative to TLT from a correlation perspective. Now, this breakout here that we have in place at the end of calendar year 2017, and the single best signal from ADX tells us that something should be different here. Now we have a new trend. We haven't had a strong trend in this ratio, an extremely strong trend. We have to date all the way back to the year 2000. This breakout tells us something has changed, and it could be different for a long period of time. ADX tells us the same thing. In the present day, 2018, we've had a big correction and a long period of consolidation in the stock market. Would a 50-50 mix have been as helpful as it was during this period? And if we migrated to bonds in 2018, would it have been helpful as it was? It was extremely helpful in 2011. Would it have been helpful in the present day? Based on this ADX move and this breakout, we would surmise that it should be different. Something should be different. Our expectations for asset allocation should be changing. And the facts bear that out. Helpful in 2011, not particularly helpful at all during the correction in calendar year 2018. Now we're looking at the S&P 500's performance from December 29th, 2017, the last trading day of the year, up until the present, or August 2nd of 2018. Notice here, when the stock market plunges, bonds skyrocket. This is the benefit of diversification. Didn't happen in 2018. When the stock market's performance started to wane here in late January, bonds did not skyrocket. They continued to fall. Unlike this period here, and unlike this very long-term period here, and unlike this period here, if we entered 2018 with a 50-50 mix between stocks and bonds, our performance would be disappointing relative to what we're used to. Year to date, long-term 30-year Treasury bond price down almost 7%, and it wasn't particularly helpful smoothing out the gyrations in the stock market as it was in 2011 or over this period here. ADX is telling us something has changed. These are facts. Black ADX stayed below red and green, and then it moved up by 4 levels. Those are facts. They're indisputable. This is a fact. On December 29, 2017, it was the first time this ratio was able to clear this level here, and this level here. This says something is different in the asset allocation world. These numbers year to date align with that. This is not what we would expect based on our experience looking backwards. And as we talked about in last week's video, we looked at small caps relative to bonds. We don't need a perfect inverse head and shoulders pattern to understand the psychology. These are our early adopters here. Something's wrong. Our head goes lower than the left shoulder. Now the crowd sees something's wrong. 2007, 2008, we rally off of the low with a lot of market participants seeing that things are improving. The right shoulder here, the shallow right shoulder, is somewhat of the late adopters or the last bit of skepticism that needs to be shaken out before a bullish breakout. And we understand this is a strong statement, but that statement is backed up by the facts that we have in hand. We have been inside of this consolidation box for 23 years. How do we draw the box? Basically take this low here, draw a horizontal line so we hit price. This first major high, a horizontal line over here would be the top of the box. The key is that the ratio stayed inside the box, never left the box between 1995 and calendar year 2017, which means our recency bias, if we look back 23 years here, it's easy to understand why people are buying bonds. They're saying, we've seen this movie before. We've seen this movie before. We won't be fooled again. But ADX and this bullish breakout is saying, we haven't seen this movie before. This movie is radically different from this movie, and this movie. This doesn't really look anything like this, or anything like this. This doesn't look like anything that we can find on this chart going all the way back to 1985. Black ADX went to its lowest level. This is the sleepy, trendless market. We haven't gone anywhere here. Sleepy, trendless. We have a similar bullish move here, but it's not nearly as good as this move because Black ADX starts to rise, but it's not below both green and red. This is bullish here before this big move, but not nearly as good as this setup here. So when we look backwards using this quarterly chart from this point here, it's very, very similar to looking backwards on this daily chart from 1994. Enter the box here, top of the box, down to the low. We really don't get out of the box conclusively until 1994. Be very, very easy to understand how people would be skeptical about stocks outperforming bonds here because of recency bias. But we know the longer a market goes sideways, the bigger the move we can expect to get. And we also all are familiar with the expression, the market needs to consolidate its gains. The market needs to consolidate its gains. The market needs to consolidate its gains. Here are the gains. Here's the consolidation, but the box goes all the way back to this point here when we connect this low. This box here is similar to this box here. This 7-year move here is very, very similar to this very long-term move here. The line is drawn from the lower left-hand corner of the box to the breakout point, from the lower left-hand corner of the box to the breakout point. And the concept, the longer we move sideways, the bigger the move that we can expect to get applies here. This is a 24-year consolidation box, much, much longer than this box. What happened after this box? Stocks significantly outperformed bonds after the breakout for 7 years, telling us to keep an open mind about much better than expected outcomes in the stock-bond ratio. Logical to be skeptical here. Good things happen for a long period of time. Very logical to be skeptical here. But the breakout and ADX tells us good things could happen for a long period of time. It's extremely important to note we are not forecasting here. We are making a probabilistic statement based on facts. We can see this change. This is different from this, and this. ADX looks different than anything that we've seen on that quarterly chart going back to 1982. Breakouts can fail, and if the facts change, then we reassess. So as we go forward, since we're not forecasting, we have to maintain maximum flexibility, and we will continue to make probabilistic statement based on the facts that we have in hand, taking it day by day, understanding that if the facts change, then we're going to have to reassess the probabilities. We've been talking about concepts like this for quite some time, and thus far taking it day by day has worked well, and we have not had to reassess those long-term probabilities. How long will that last? We have absolutely positively no idea, and we will continue to take it day by day and use maximum flexibility to keep our ego at bay. If you're new to these videos, you still may be skeptical, and that's very understandable based on what's happened in our adult lives. Since the CCM market model is based on the weight of the evidence, Is there anything else that aligns with the theory that good things could happen for a long period of time in risk assets relative to defensive assets? Clients and regular viewers know the answer is yes. Similar situation with the average stock. Entered the orange box in the early 1980s. We get the bullish breakout here and somewhat of a retest. We rally. This is the present day correction, the one that we just went through. And it's extremely important to note, this is a monthly chart as of July 31st, 2018. Let's zoom in on this portion of the chart. Same value line geometric index, July 31st, 2018. The monthly chart printed a new all-time monthly closing high at the end of July. It's very, very difficult, if you understand what the value line geometric index is, to look at this chart and get concerned at all about the performance of FANG stocks. This stock market is not being led by a small number of stocks. There is very, very broad participation. And as we've covered in past videos, it is not unusual for the top 5 or 10 stocks to be big-time leaders in a bull market. So this new all-time monthly closing high increases the probability, this is a higher high now, that this breakout is going to hold. And we can see very, very similar crowd psychology in this consolidation period. And if you know the psychology of an inverse head and shoulders pattern, which is a bullish pattern, we want the right shoulder to be shallow relative to the left shoulder. This is telling you that the number of market participants or the desire to sell here is muted relative to this point here. This shallow right shoulder tells us there are a lot of market participants, large institutions, that are adopting a long-term bullish stance that aligns with the charts in this video. Very, very similar situation here. We can look back 35 years. How can it be 35 years? Well, if you bought the average stock in 1982, you were basically at break even at the lows in 2009. Average stock, it's easy to see how people would say, we've seen this movie before, we've seen this movie before, we've seen this movie before, we've seen this movie before. This is a different movie. The longer we stay above this box, it tells us the movie that we think we're watching no longer applies. And that will be true as long as these breakouts hold. And of course, that's to be determined, and we'll take it day by day. Is there anything else that aligns with the theory or hypothesis that asset allocation or the results of using a diversified pie chart could be quite a bit different going forward relative to looking backwards? The answer is yes. We covered in last week's video. This is small caps relative to long-term treasuries. 1997 on the left side of the screen, the present day on the right side of the screen. It's very easy to understand how people are skeptical here about investing. That's really all they know. But the charts that we're looking at in this turn in ADX tell us that the next 23 years could be quite a bit different than this 23-year period here. And pie chart performance could be significantly different than pie chart performance in this 23-year period. And if you want to understand where the recency bias comes from, let's assume in 1995 you were 7 years old. In 2018, you're 30 years old. Let's assume in 1995 you were 55 years old. In 2018, you are 78 years old. That tells us that the vast, vast majority of market participants, those in the present day between age 30 and age 78, pretty much everything that they know, looking back 23 years, about asset allocation, pie charts, stocks relative to bonds, and diversification could be changing in a significant way. The charts that we've reviewed tell us that it is highly unlikely, and we're talking about probabilities, that if we look back in 15, 16, or 17 years, that the performance of the S&P 500 is going to be identical to the performance of a 30-year Treasury bond as it was over this period here. Again, that's a probabilistic statement based on the facts that we have in hand today, a statement that is subject to significant revisions if the facts change. This recency bias refers to asset allocation, and it refers to the stock market in general. The average stock peaked in 1998, was rejected at the exact same level in 2007, stalled at the exact same levels in the neighborhood of 2014, came down, made a bottom in 2016, and now this looks significantly different relative to this, and this. And this looks significantly different from anything dating back to 1983, because the average stock from 1983 to 2017-ish stayed inside of the orange box. It never left the box until the present day, telling us that our perceptions about the stock market may change significantly in the coming years, because good things could happen for a long period of time with the average stock. The next few years will probably look a lot more like this move here relative to this period here. And thus, this concept or quote here applies to asset allocation as well as technical analysis. People tend to think that technical analysis is unreliable because they tend to pick the one thing they are comfortable with. The problem is that no single technical approach works all the time. You have to know when to use each method. The same concepts apply to pie chart investing. We have to know what technical strategies align with this type of market, and we have to understand what type of asset allocation strategies align with this market. And we have to adjust now. This is a different market. It will most likely be different from anything that we have seen in our entire careers for most of us. I started at Morgan Stanley in 1994. Thus, all of my preconceived notions about asset allocation and the stock market, most likely going forward, will be proven to be incorrect. The next 23 years will probably look quite a bit different from this 23-year period. And thus, we have to adjust. And clients and regular viewers, if you think about all of the topics that we've covered in these videos over the past 12 to 24 months, they are all singing off the same hymnal. Asset class behavior, breakouts, long-term breakouts in major stock indices around the globe, and the economic data has improved considerably. One example, jobless claims hitting a 45-year low. And market fractals tell us that these concepts apply to all time frames. Thus, this point here where we're skeptical is very, very similar to this point here in the Dow, where it would have been very, very easy to say this will end badly. It didn't end badly. This point here in our stock versus bond chart is very, very similar to this point here in the Dow. Very, very easy looking backwards to say this will end badly. It didn't end badly. It rallied for an additional 17 years. And if you're skeptical because you say, well, we've been rallying since 2009, this really isn't the rally. The rally is starting right here. This is consolidation. all of these moves here, so from point A here, we rally for an additional 18 years, tack on 205%. This number and this number does not include the rally off the low. From this point here, we rally for an additional 17 years and tack on 998% in the Dow. This number here and this number here does not include the move off the low, which again means this move here is part of our consolidation and has very, very little impact on what could happen after the breakout. We fast forward to the present day, we have a very, very similar situation in the Dow as well. So if we're skeptical about our stock bond chart, this point here is very, very similar to this point here in the S&P 500. This is the 1950s. After the breakout, good things happen for a long period of time. This point here is very, very similar to this point here. Very, very easy to say this will end badly and logical. It didn't end badly. It rallied for an additional 18 years. It doesn't include the move off the low, and tacked on an additional, in round figures, 1,100% from the breakout S&P 500 price to the high, which happens inside of the consolidation box. The facts that we have in hand today tell us, from an asset allocation perspective, that a pie chart that's worked extremely well since the mid-1990s may not work well at all relative to the stock market for a very long period of time. Quickly, using a weight of the evidence approach, if we're still skeptical that good things could happen for a long period of time in this ratio, if this breakout is going to fail, we would expect to have evidence in hand that shows waning momentum in the stock bond ratio. And if we're going to have something like this or something like this, then we would expect to see hard evidence of waning momentum in the stock market when viewed in isolation. In this example, we'll be looking at the S&P 500, and we're using the simple 30-day moving average in blue all the way out to the 275 in gray. If you know your market history, you know in the year 2000, the S&P 500 peaked in March, but it really didn't roll over in a convincing manner until after September 1st. So at this point here, blue, our fastest moving average is on the bottom, and all of the slopes are rolling over. We can see this. When we could see all of this, this is hard evidence. We don't have to forecast anything. The S&P 500 was still trading at 1315. What happened next? After we had the evidence in hand, the S&P lost an additional 41%. Similar situation here. Calendar year 2008, S&P 500, full bore bearish from this perspective. Blue, the fastest moving average, has moved from the top to the bottom, and all of our moving averages are rolling over relative to the slopes. This looks quite a bit different than this. After we could see this, measure it, put it in a model, what happened next? From that point where we could see all of that, the S&P was trading at 1325, and it dropped all the way down to 666, meaning after we could see this, the S&P 500 lost an additional 50%. We didn't need to forecast anything. Thus, a logical question, in the present day, do we have anything that looks like this or this? The answer is no. These are the exact same moving averages as of 12:22 p.m. on August 2nd, 2018. This really doesn't look anything like this, and this really doesn't look anything like this. We'll continue to take it day by day. Same is true for the total stock market. Still looks good, VTI. And if you believe that breadth is a problem and the average stock is not participating, we still have a very constructive look with an equal weight S&P 500 ETF on August 2nd ticker symbol RSP. This look here with blue, the fastest moving average on top and all of the slopes up, is not particularly concerning from a probability perspective. This is the type of look that we do want to avoid or we would be concerned about. You can see here, blue, the fastest moving average is almost on the bottom and the slopes are all down. This really doesn't look anything like this, and this looks a lot more like this or this. What are we looking at here? From a conceptual perspective, we're looking at what an established and ongoing bearish trend looks like. And what is this chart? It is the ratio of long-term treasury bonds relative to the S&P 500. So the concerning look in the present day is not about stocks. The concerning look is about bonds, which aligns 100% with the theory that good things could happen for a long period of time, and it also aligns with the bullish single best signal coming from ADX. If you're sitting at home and you're new to these videos, you might say, well, we're near new all-time highs. Shouldn't we be concerned? During a secular bull market, the stock market can make new all-time highs for literally years. Viewed in isolation, the fact that the stock market in the present day is near a new all-time high tells us very, very little about the market's risk-reward profile. We could have made the same argument here in the 1980s. I'm concerned we're near a new all-time high. I'm concerned we're near a new all-time high. Here's long-term momentum. We covered this chart in November of 2016. Monthly MACD for SPY relative to TLT stocks versus bonds. Bullish cross. Doesn't look anything like the concerning turn here and looks a lot like the constructive turn in 2009. How does the same chart look today? Is momentum waning? The answer is no. We still have black above red, constructive look. And this sideways movement here of slowing momentum is just indicative of a market that needed to consolidate its gains. The ratio consolidated its gains and has broken out to the upside in a bullish manner, favoring stocks over bonds with still constructive long-term momentum as of August 2nd, 2018. And we know from past videos that even if good things happen for a long period of time, volatility is going to be part of the equation. We know that with 100% certainty. The gain with no trades from point A to point B is 16.68%. There are a lot of pullbacks between point A and point B. If we focus on volatility, instead of focusing on the trends, this is very, very unnerving. This is a lot easier. This is the same point A and same point B using the 100, 200, and 300-day moving averages. How do the exact same moving averages look today? Are they rolling over? The answer is no. 100, 200, 300, August 2nd, 2018. This is not particularly alarming here. Market looks like it's trying to right itself. We don't have any bearish moving average crossovers, and the slopes of all of them are still constructive. And during the entire correction, the trends still looked constructive. The facts that we have in hand today tell us to keep an open mind about better than expected outcomes occurring for a very long period of time. And under our approach, it's extremely important that we head into next week and every week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.